terms of returns, yes, it will be, we have not really prepared the offer document, which is under preparation right now. But I think in about, by end of this quarter, we should be ready with all those numbers. And it will certainly significantly differentiating than a standard East product, which is what generally the main REITs are working at. So it will certainly be better than them. But in terms of exact numbers, I'll be able to tell you by the time the offer documents are completely ready.
Fair enough. Thank you so much, sir. All the best for the coming quarters.
Thank you so much. Thank you so much, and sorry for the disturbance.
Thank you. The next question is from the line of Rishabh Gang from Sacheti Family Office. Please go ahead.
Hello, sir. Am I audible?
Yes, please, Rishabh. Thank you.
Yeah. Thank you for the opportunity. So I want to understand, more on the 5-year vision, right, on the kind of business you would want to build across your different segments, and possibly some kind of numbers relevant to each segment, like how big you would like to make them. And would want to know which new geography you would like to enter in future, and any more adjacencies or segments that you plan to enter into or think about that they are interesting. Yes, sir.
Right. In terms of overall outlook going forward, Rishabh, we're looking at keep adding about 30 to 40,000 seats on a year-on-year basis for next, I would like to right now say at least for 3 years. That's the plan that management has already kind of put in place internally. And the way the managed office business and the flex office market is growing, and the overall economy is also supporting the same, we are fairly confident that for next coming 3 years, we'll be able to really keep adding the seats. You would appreciate that adding seats is not a big challenge. The challenge is in terms of whether there is a demand sufficiently available. And we are very confident that for the coming 3 years, that will be the scenario, that we'll be able to easily absorb more than 30,000-40,000 seats that we'll be able to kind of put in place. And with the policy that we have, that we generally price our product at a reasonable level, anything between around 6,500 to 8,000 rupees, depending upon the area, locations, etc. That's the broad target with regards to the managed office business. With regards to the D&B division and the furniture market, as far as the D&B division is concerned, we are very upbeat because if you would appreciate, there are hardly any pan-India players and organized players who have a capability to carry out such large contracts across India single-handedly. And the way the growth is happening, the kind of response that we are getting from large customers, we are very, very confident that, with the economy also supporting the real estate sector on the commercial leasing business side, we should be in a position to really achieve, or rather keep doubling our targets year on year than what we have achieved last year, which is a very conservative and realistic estimate that we can make, looking at the kind of orders that we have in hand and the orders in pipeline. With regards to the furniture manufacturing business, we are very confident that by end of 26, we should be crossing around 250 to 300 crore top line. That is what is expected from that business and that unit that we have really set up right now. So by FY26, we should be in a position to cross 300 crore plus of business on the furniture manufacturing side. In terms of geographical expansion, as I mentioned earlier, that our focus for next couple of years would remain the 9 cities. Having said so, we are clearly aware about the new markets getting developed, new tier 2 cities getting developed, and we'll be closely watching them, and we'll definitely support our existing clients if they want to really move to those region and kind of asking us to kind of help them set up the infrastructure there. But in terms of our own direct focus would definitely remain around this 9 cities going forward in the coming 3 years' time. I hope I've kind of covered up all your questions in this.
Yeah. Actually, one more question was there. Any more adjacencies, right, or segment that you plan to enter into, which are related to your business, maybe which you find interesting at the moment?
As of now, we are genuinely speaking very focused on opportunities on hand. We believe that this segment already we have kind of covered all the aspects of our core business, that's the managed office or the office leasing business. So as of now, there is nothing that is on plan or nothing on card. We are in business and it's a dynamic environment, right? So opportunities may throw up and we may consider them, but as of now, there is no such plan, please.
I also wanted to understand more on the inorganic growth, like when we have acquired one company right now. So what is our view? Like, would we be acquiring more such similar kind of businesses across India? And how do we evaluate these businesses? Like any parameter linked to acquisition cost per seat, or how do you evaluate buy or build or buy decisions for such businesses?
Oh no, very very great questions. Yes, inorganic growth is necessary for any organization like us who is growing well right now and who has been able to generate sufficient internal accruals. So yes, inorganic growth will be on card, and we will be looking at such opportunities where we could acquire and step in and play some strategic role while expanding our strength. So in terms of when we get into acquiring such potential companies, we definitely wouldn't like to give them a situation of an exit. Okay, we would definitely like to associate with them to do how do we really associate in a manner that we can really help them to grow further, and how do we really associate so that we are in a position to fuel their growth plan as well. So it has to become a win-win situation. If I go into a pure vanilla acquisition deal, then my cash outflow and my acquisition costs would become too high, and that might not be a viable proposition considering the current situation in the market. The industry is doing very good, and if I try to make a deal right now to acquire a business completely, which is doing fabulously well and it is also growing at a very good space, then the acquisition cost is going to go very high. But I have to look for such opportunities like Bitbox, who are at a reasonable scale and now looking at growing further. And that growth could be fueled by the kind of overall infrastructure that we have got. So we've got, what do we really have to offer? We have to offer the DNB division, which is fully functional, fully capable of handling any kind of contract that is to be executed in a very limited period of time. Secondly, we have our own furniture manufacturing business, so that kind of offers them a very customized and timely basis and price-sensitive product to them. So that takes a win-win proposition to us, and that's how we try to acquire such companies, not by going into pure play acquisition model, because that becomes, you end up paying certain multiples or certain number of sales multiples or EBITDA multiples, and that probably doesn't work in our mindset. We are looking at a situation where we do strategic acquisition with some growth fueling exercise that we can do for the target companies. If time allows, I would like to ask one more question. Like for the properties that we are trying to own and then run it as a space, so what is the kind of IRR or return on investment do you expect to make post? Like, what is your leveraged returns on that? Like, what is the benchmark that beyond this you would like to do this? So, to be very honest, when we acquire a property, we would obviously like to have acquired it at, like I said, at lowest possible cost, because, I don't want to get into an acquisition where, the difference between my EMI and and my payment to and the rental around that is more than 1% or so. The arbitrage can't be more than that, because the moment I get into a higher arbitrage, then, that acquisition is not efficient for me. So what you are looking at is below 7% kind of an yield, kind of a property that I would like to identify and acquire, and kind of size that we are looking at, and the opportunities are there in the market. All the past acquisitions that we have done are all on the similar lines and on the philosophy. All right.
for the furniture that we have, like the backward integration, has any other player also done that? And, what are the kind of entry barrier, right? For another office space to actually also backward integrate to furniture. Like, what are your views on that? Just broad views.
So, with regards to whether anybody else has done that, to our best of our knowledge, we are not really sure that anybody has done that. We are basically, we are one of the few, the only one I did it like that. So, we are operating as real estate as a service provider, and this integrated solutions, I doubt that anybody else is providing, number one. Number two, with regards to, the overall furniture business is concerned, we are, we'll be able to expand into all the different, categories that we are focusing on. And any other follow-up questions you had on the furniture business?
Yeah, I just want to understand, how hard is it for another player to actually start doing this backward integration for furniture, right? Some qualitative insights on that.
Yeah, it is difficult. It's not an exercise that one can just simply think of and just have access to capital so that you can just simply put it and you're able to manage it, because you could understand that that's how the manufacturing sector and the service sectors are different. But fortunately, we've got a team of people. We've got experienced management. Our promoters have also historic experience of doing having understand the manufacturing sector. So it is not easy for sure. You've got to have the right blend of team and obviously the right type of opportunities on card available, which enables you to, kind of get into this expansion into the furniture manufacturing.
Excellent. Thank you so much, sir, for the valuable insights. Really appreciate it.
Thank you.
Thank you. The next question is from the line of Darshan Jhaveri from Crown Capital. Please go ahead.
Hello, good evening, sir. Thank you so much for taking my question. Firstly, congratulations on a great set of results, sir. One clarification, if I heard it correctly, we are trying to double our top line by FY25. Was that? Did I hear that correctly, sir?
Oh yes, that's the endeavor, and that is the target that we have kept it for ourselves.
That's great to hear, sir. So, just two questions. One, now when we add, furniture to our so what kind of EBITDA margins would, we would be, getting in that business, and what would be our blended EBITDA for, when we do all three combined, or any good margin differential in all three businesses, what would that be?
So in the furniture vertical, the EBITDA margins are typically around 40%. Obviously, it will take about 6 months for us to achieve that efficiency. But a standard thumb rule, as I said, in the furniture industry is about 40%. And that's what our costings are also looking at, and the kind of market price that we can understand based on the preliminary feasibility that we have carried out. With regards to the blended margin is concerned, on a managed office business, we do, about an EBITDA of about 30% on a site level. And on the D&B division, we do an EBITDA of about 15 to 17%, or rather a little more, about 17 to 19% on an EBITDA level, 14 to 15% on a PAT level. So on a blended level, it will still remain around 30% on an EBITDA. These are the EBITDA I'm talking on an Indian GAAP accounting standards, not as per the reported, which is Ind AS, where the EBITDAs are generally higher. So, but if you look at on a business side, on a cash flow level, the cash flow level EBITDAs blended would be around 30%.
Oh, fair. So what would be the differential between reported and Indian GAAP, sir? Or maybe could you just talk about PAT numbers, because that would be much more easier then, sir.
So that's what I'm saying, that I'm kind of telling you about a number that is something which would be subject to tax, which is 30% EBITDA on my top line. reported EBITDA, reported numbers, like I said, it's a little a different situation because of the way the Ind AS accounting standard operates. We have to, consider the different, creation of that right of use of assets, etc., and then amortizing them so that the rent expenses are, rather than debited to the, before EBITDA, it gets debited post EBITDA, and hence the EBITDA level increases, but the PAT level decreases.
Okay. Got it, sir. And so just like now we are talking about, a 3-year plan where, we are adding so many, around 30,000 seats a year and everything. So what would be our vision for the next 3 years overall basis, like our revenue growth? Because we are talking about very strong numbers even in furniture manufacturing as well as, our B&B division. So, could we, in the next 3 years, what would be our internal target to, reach in terms of revenue?
So as I've explained, internally we are looking at adding around 30 to 35,000 seats at a rate of, let's say, about 7,000 to 7,500 rupees on an average basis. On the managed office business, over the 3 years' time, we should be in a position from around 50 to 75 crores to 300 crores of turnover that we'll be able to achieve under the furniture manufacturing business. And on the B&B division, we are absolutely confident that from the 100 plus crore, that is 113 crore that we achieve in FY24, we should easily be able to double it year on year, because the way the responses and the contracts that we are, securing and the businesses are getting generated, we are absolutely confident. So I think, you can appreciate this is the broad guideline that I can provide. And this is the kind of numbers that we are really targeting at.
Oh, yeah. That's, great to hear. So that's very great to hear. So just like one last final question, to just maybe it's part a question. So just like with such a, great opportunity for growth, will there be, very intense competitiveness with other players coming in? And what kind of risks that you could see in our market, sir?
So, in terms of competition, the market is open. Yes, marketing is gearing up. People are, focusing on this segment. But as you can see, there are a handful of people who have a pan-India presence and who are really have established themselves as managed office players or somebody who is into the operation model. So, while this business has no entry barrier, but to get to that efficiency level at which everybody like us is operating, that's not going to be very easy for, every new entrant. And also to become a significant player, that's not an easy task that you can achieve it over, next 1-2 years, okay? So you would appreciate that we have reached to this scale, this size, this efficiency with our over 10 years of experience in this business. So it is while it is easy to say there is no entry barrier, but to achieve such efficiencies and to enable yourselves to make continuous profitable business, it is a challenge that one has to go through. And we are very cognizant of the fact that, the overall risk which one can really foresee is the risk related to the overall downturn in the economy. Because otherwise, if you see, the way the real estate sector is growing and way the business sectors are growing in terms of demand for leasing office leasing sector is continuously increasing only. And the way that projections are, we are very confident that at least for 3 years that we are talking, there isn't likely any downturn which is expected. Barring some force majeure event which nobody can really estimate. We are very confident that we should be able to sail through these 3 years confidently and, on a growing trend only.
Oh, that's very great to hear, sir. Yeah, that's it from my side. So all the best for the future. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address the questions from all the participants, please limit your questions to 2 per participant. I repeat, please limit your questions to 2 per participant. Thank you. The next question is from the line of Bhaktesh Oza from Vyom Wealth Advisors. Please go ahead.
Good evening, sir. So congratulations on a good quarter. So my question is, in the last con calls and the management commentary, you have been mentioning that you are having competitive cost advantage when it comes to your comparing with your peers. So because of that, you are gaining more advantage. So my question is, are we getting this cost advantage from TCC concepts because our promoters are holding a majority of stake in TCC concepts? So are we getting managed offices spaces at a reasonable rent from TCC concepts? That's what I wanted to know.
So TCC Concepts is an independent company which is not, which is not kind of having any, business connections with the EFC India Limited. And there is nothing that we are deriving from them in terms of which adds to my cost competitiveness. What adds to my cost efficiency is the integrated vertical that EFC India Limited has developed under the three verticals that it has developed, which is, as you know, my furniture manufacturing, my DNB division, and the managed office. So that is where we really control our costs, we bring our efficiencies, and maximize our profitability.
Okay, so I was going through annual reports of TCC Concepts and of FY23. So there were some related party transactions where EFC's name was mentioned, and the amount was around 2.5 crore or 250 crores, if I'm mistaken in amount. But can you please explain what those transactions were?
I would not. I mean, it's absolutely fine when there are those transactions are arm's length transactions, and if there is any connection, but that has nothing to do with the business of growth of this company, and I think we'll be able to address those things in the TCC conference call. But right now, as I'm saying, that there is no connection from a business side that it is fueling my growth or, enabling me to, achieve any efficiency on my cost, etc. from that company is concerned. Okay.
And so my last question is that TCC last question is for TCC only. So TCC has stepped down subsidiary.
If you don't mind, I mean, we can rather focus on EFC India Limited at this point of time with the lack of time than getting into the other company, please.
Yes, absolutely. But the promoters are the same mind. So that's the reason I wanted to know a bit about TCC.
Regarding this particular company, that is why I'm requesting you, sir, that if we can focus on this, then because of the lack of time, we can focus on EFC India's result, please.
Okay, no, sir, that's it from my end. Thank you. Thank you for answering.
Thank you so much. The next question is from the line of Nirmal Murarka from VT Capital. Please go ahead. Mr. Nirmal, your line has been unmuted. Please go ahead with your question.
Hello, can you hear me?
Yes, sir.
Yes, sir. Yes, sir.
Yeah, sorry. Yeah. My question was regarding the rental income. So it has been flattish Q on Q, despite increase of 5,000 seats in build seats. So what explains this, if you could please clarify on that?
Yeah, so there is an increment in seats during the quarter, obviously, and that's what every quarter we plan to. But generally, as you could appreciate, and if you see, our last year's trend, the quarter one and quarter two are the quarters where we do maximum of development, and that is where the number of seats are getting built up, and then they're coming up for occupation. So during the third and the fourth quarter, where you see the maximum occupations in terms of the number of seats which have come up and developed during these two quarters, and then the revenue and the profitability accordingly shoots up. So that is the kind of trend then generally that we follow in our business, in this particular managed office business. So if you compare it with the last 4 quarters, you will realize that, on a quarter-on-quarter will be increasing. And on an average, if you see, every quarter will be adding about 3,000 to 4,000 seats on a billable seats. But in terms of capacity, it will be more, and that's how there will be a little lag between the the income and the expenses, which will happen on a quarter-on-quarter basis. But on an average basis, you'll see that we will have a average profitability across all the quarters matching up, totaling at an average of about 15 to 16% on an annual basis.
Actually, sir, I wanted to know from the revenue side, like if we're increasing seats, so why is the revenue flat Q1Q? That was my question.
So that's what I'm trying to explain, that during the first quarter, the seats and the developments are more there. Though all the seats which are getting developed, they might not get occupied immediately because, there is a lag between the development and the occupation, correct? So let's say if the seats are getting developed, they will come up for occupation, they will start getting billed on a particular date, but it will not be billed for the entire quarter. You appreciate? Because let us say, I'm hypothetically saying that No, I got that. But if you have added 5,000 seats in this quarter, so have those not yet got occupied, or what is that split if you could? So they are occupied, sir. They are occupied, but like I said, that let's say if, I'm saying that most of the seats would get occupied during the month of June. So obviously the incremental revenue would come because, there are the earlier months we'll do the developmental work and it will get occupied during the month of, let's say, in the later half of May and the earlier half of June. So the additions would see on the revenue side would start increasing from June onwards. Okay, so the overall quarter impact would not come in that particular quarter. And generally, the way we work, sir, is that the fourth quarter of any financial year is the year in which we kind of develop and identify potential properties that we want to acquire on a leasehold terms over the coming financial year. And then we kind of get into, acquiring those leasehold rights, starting from the last quarter of a particular financial year and beginning of the next financial year. And then according to the developmental cycle happens. And the third and the fourth quarter is the quarters where my revenue starts picking up, kicking in more. While on the other hand, because the developmentals are going on, certain fixed expenses, certain standard, developmental expenses keep getting debited to the P&L. So there will be a revenue mismatch to that extent. You see that the revenues are not going increasing vis-a-vis the expenses are concerned and so on and so forth. But on an average, once you look at a particular financial year, between the two quarters, initial two quarters and the later two quarters, the average numbers would give an overall sense of the performance of the company.
Okay. And sir, related to this, your assets and your rental income, there is a segment called assets. So why has it fallen from 9 crores to 1 crore YOY?
So what we were also very active on is that there were certain transactions where we were contracted where we were just providing the furniture fixture and also the managed office services, where the space was not something that we were acquiring, we were taking on the lease from the landlord, but only the furniture were provided to a particular customer on the space which they own. And then we provide them the managed office services also. So that is the asset leasing business what we are talking about. But, in that business, what happens is that the controls are limited, as we have seen and observed over the period. So we are trying to reduce our operations because there is too much of demand on the space leasing side. And, our ability to focus on the asset leasing business is getting limited. And obviously, as I explained, the control aspects. So we are kind of reducing those exposure and rather also focusing more and more towards the space rental business.
So my final question would be what would be your guidance on the rental income for the full year?
We are fairly confident that, for the full year we'll be crossing around, right now, as I said, that we are already at 47,000 seats. By the end of this financial year, we'll easily be around 65 to 70,000 plus kind of seats. And on an average, if you have to ascertain that what would be the average occupied seat during the entire year, if you do an annualized average, we are confident that we should be able to have around 55,000 seats on an annualized basis at an average rental of about 7,000 rupee per seat kind of a thing. So we are looking at more upwards of 350 crores on the top line that we will be able to project for this